Cam Brar for Cam's Mortgage Minute. I get asked quite often about mortgage insurance. Well, how does it work? So I thought, hey, what a great opportunity today. Let's step back and let's see the ins, the outs, and the nuances of it. First off, Canadian mortgage insurance essentially is what it sounds like. It's insuring the mortgage. It's primarily done by 3 companies in Canada. They would be CMHC, that's a Canadian Mortgage and Housing Corporation. They are a Crown Corporation, so you and I as taxpayers are participatory in them. The other 2 are Genworth and Canada Guarantee. They're private insurers. And basically they have about 25% of the market share combined, and CMHC dominates at about 75%. Now, CMHC's original purpose and why it was set up was to help homeowners get into it, actually become homeowners. I mean, the bottom line is our home ownership records are record highs now, and that's due to the fact that lenders can insure mortgages. Now, you might ask, well, why was a lender want to insure a mortgage? Well, bottom line is they want to mitigate risk. When borrowers have a limited down payment, let's say 5%, 10%, anything under 20%, lenders consider that a risk and they want to mitigate against that. And how they do that is by insuring that mortgage, and you wind up paying the premium for it. So even though you are getting mortgage insurance, it's really not for you. It's, well, I guess indirectly it's for you, but it's primarily to protect the lender. So let's take a look at a real life example of how that would work. Let's say you were to buy a house for $300,000 and you had 5% to put down. So you could put $15,000 down. Now in that scenario, you would pay a premium of 2.75%. Now these premiums vary depending on the amount of your down payment. As I mentioned, if you have 20% down, there's no premium, but from there, there's different varying degrees of it. So in this scenario, you'd have 2.75%. Essentially, you'd have a $285,000 mortgage plus your premium, and you roll out of here. And let's say everything's going fine in your world and it's all wonderful, and 2 years later you get into a lot of problems. For whatever reason, the house goes into foreclosure, the bank's forced to sell it, and there's a big loss. And let's say at that point you owe $290,000 on the mortgage, the house sells for $250,000. The $40,000 loss is paid out by CMHC to the lender. So that's what it's designed to do. It's designed to protect them. CMHC uses those premiums to basically be their buffer. Now, you might say, well, hey, what do we really need it for? Well, the bottom line, as I mentioned to you before, is lenders do not want to assume that risk without that insurance. CMHC backs the lenders 100%, whereas Genworth and Canada Guarantee are to about 90%. So the lenders obviously prefer to go to CMHC first because all of their risks is mitigated, and with the other 2 insurers it's a little bit more, but they still use them at different times. Bottom line is there's been a lot of talk lately about the fact that CMHC, Canada Guarantee, and Genworth should start reducing their premiums. The fact that they're charging a fair amount, and that really the new underwriting guidelines have made things far more stringent, and that really the overall risk is reduced. Now, there's a lot of truth to be said to this. Delinquency rate among the insurers is at extreme lows right now. The underwriting guidelines, no doubt, are very tough, and they do make qualification tougher overall. The quality of paper credit-wise, the borrowers that these insurers are getting overall are certainly more well-heeled, more well-positioned. As I mentioned to you the other day, they're doing all kinds of things like making people qualify on benchmark rates. So all these different things are designed to weed out folks that maybe are not as solvent, not as strong, so that way they are putting the best candidates into these programs. Having said all that, do I agree that they should drop the premiums? No. At this point, we're still got some concerns as to which way the market's going to go. We've got concerns where people are saying, hey, the condo market's quite fragile, there's a lot of inventory. All these things, in my opinion, is until we get past all of that, we should leave well enough alone, and we don't want to take that risk. Bottom line is, as taxpayers, we participate in CMHC. I'd rather have them have a large war chest, so if something goes wrong, we're well covered. Now, CMHC makes about $1.1 billion they made per year over the last 5 years they've averaged, which is amazing numbers. And again, some of folks might say, hey, well, that just means that they're making too much profit and they should be changed. But however, you got to remember that they're a Crown Corporation. This money gets pumped back into the federal budgets, and it's used for all kinds of different sorts of things. Now, the good news with the CMHC premiums that you have to keep in mind is that you don't pay for those up front, which is fabulous. So your mortgage in that example of the $285,000 mortgage, you're not having to be forced to pay the premiums up front. They're added into your mortgage. However, as we all know, with them being amortized over a longer period of time, you're going to pay some interest cost on those. But if you don't have the money or the cash up front, it's the surefire way of getting into the market. So that's it in a nutshell. Now, one more point I will mention where I do get asked often is, if I've owned a home before, am I still eligible for CMHC? Absolutely. You could have owned 5 homes, 10 homes, 15. It doesn't matter. Just because you've had insurance, mortgage insurance in any form before, doesn't mean you're restricted to having it again. The only area where we have challenges is if you've had a foreclosure where one of the insurers has been involved. At that point, things do get more challenging to get approval. So that's on a case-by-case scenario. So I hope that clarifies things for you as far as mortgage insurance. So bottom key points to remember are, if you have less than 20% down, you're going to need mortgage insurance. Mortgage insurance is added to your mortgage. It's not a premium you pay up front. There's a graduated scale depending on your down payment, and it does definitely allow you to get into the market. Any more questions with mortgage insurance, anything related to mortgages, don't hesitate. Call us at Auxilium. Auxilium, as I tell you time and time again, means simply to care, aid, assist, and support. And at the Auxilium team, that's what we're here to do. We look forward to assisting you, and have a good day.